The average true range, or ATR, is a powerful indicator for measuring price action momentum. It is officially classified as an oscillator, meaning it is intended to quantify the degree of pricing volatility, not determine market direction. Remember that. Volatility, not direction. Now, the ATR is a creation of classic market technician Wells Wilder Jr. Originally, it was designed for the trade of commodities. In this video, we'll show you how to apply the ATR to anything. Forex, futures, cryptocurrencies, you name it. Okay, reality check. Calculating the ATR in real time is difficult, but there's no need to worry. The functionality of the ATR is fully automated. It is plotted in a separate window beneath price action. Nonetheless, to trade the ATR, it helps to be aware of its key components. All right, it's time for a crash course in ATR derivation.
The first key concept of ATR is true range. The true range is the distance between a period's extremes. It is the largest of these three values. The current period's high minus the previous period's close, the current period's low minus the previous period's close, the current period's high minus the current period's low. Let's take a look at an example of Nike stock. So what is the true range calculation for Nike given this scenario? Yesterday, Nike shares closed at 98.75. Today's Nike high is 104.75. Today's Nike low is 94.75. What is the true range? The true range for Nike is $10, the distance between today's high and low. As in name, the ATR is an average of true ranges. So to find the ATR, we take an average of previous ATR values. Here's a look at 14-day sample average of Nike true ranges. Now, we make the average current by plugging it into the equation you see here. This is our current ATR and what we see on our charts. Obviously, this equation is way too cumbersome to calculate in the live market. That's why the ATR is automatically calculated and plotted on your pricing charts.
There are three basic ATR trading strategies: reversal, range, and breakout. First, reversals. A high ATR value is viewed as being a signal for a change in market direction. So reversal traders look for high ATRs and plan their entries against the trend. Second is ranges. A low ATR value is viewed as being a signal of market consolidation. In this situation, range traders look to buy a range's lower extreme and sell the upper extreme. Third is breakouts. Breakout traders look upon a low ATR as the calm before the storm and the precursor of a directional move in price. All right, let's take a look at a few examples in the live market.
Okay, let's look at a few examples of how to trade the ATR in the live market. We're going to look at three different ways: trading reversals, range trading, and breakout trading. This is Trading View. We're going to show you exactly how to set up the indicator. First thing you're going to want to do is go up to Indicators, cursor right down to Average True Range. There it is. Click on it, and you'll notice that it's plotted beneath price in its own separate window, and you'll notice that this line is our ATR value that we went through just a second ago, how to derive that. Okay, the first way we're going to trade this is a reversal. Now, what reversal traders look for a high ATR, and what that means is they want to see an elevated ATR reading. That's a signal that the market's, number one, it's alive and potentially could change directions. As you can see right here, we have a 30-minute Bitcoin chart. We went through a period of relatively high ATRs compared to where we were back here, but you'll notice this big directional move, this big bearish sell-off brought us a peak in the ATR. Now, what does that mean? It means that we saw an incredibly elevated level, and now as soon as we saw the ATR start to recede, that's a signal that potentially we could see the market change direction. Right here, we have a defined swing low, and as you can see, since that swing low and really that peak in the ATR, that would have been a signal to buy the market and capitalize on bullish price action. So that's number one. That's how to trade a reversal using the ATR. Number two is how to trade rotation. Now, this is a little bit trickier because you have to be astute with identifying a range. It's still relatively straightforward. So the first thing we're going to do is we're going to be looking for a period of a low ATR or a descending ATR. Now, as you can see right here, a 30-minute US dollar Swiss franc chart. You'll notice right up here we had some pretty good ranges, and then we saw a nice directional move and sort of an elevated ATR, and then we went into a period of a descending ATR, and you'll notice what happened. Our price action really flattened out. These price ranges, these 30-minute bars got very small. Now, one thing I want to point out is everybody's saying, okay, well, there's a peak there, or excuse me, a trough there, and then a rebound. Well, yeah, but take a look at what your range is, 88.44 to 88.30. That's extremely tight. That's a 14 pip range on the 30-minute chart. That's extremely tight. So our descending ATR put us into a very flat market. Now, the way that we would be looking to trade this is either to sell the top of the range or buy the bottom of the range. I would, in this situation, we'd be buying the bottom of the range, and we would have bought it right here. Now, essentially, you're saying, oh, but look at that big directional move. Well, look how far it went. You're buying 88.30s, and your low right there is 88.25. It's an 8-pip draw. It's very small, and you'll notice price is rotated right back up into that range. ATR is also descending. So that would have been an opportunity to range trade this, either sell the top or buy the bottom when you've got that descending ATR, and what that can do is get you into a decent trade, potentially as a scalp trade, or maybe even a position, riskier as a position, but definitely a reversion to the mean strategy is appropriate there. Buy the bottom, midpoint would be a profit target, something like that, very tight. Interesting way to trade the market. The last one is going to be using the ATR for a breakout type of a mentality. Now, when we talk about trading breakouts, basically we're talking about getting into a compressed market and looking for that market to break. And when it finally breaks, you're going to want to get in on that directional move. We'll take a look at what we have here. Breakouts, we're looking for that low ATR. We want a static low ATR value, and then we want some sort of market driver, typically to drive participation and pick business up a little bit and drive price maybe to our profit target. As you can see right here, this is a good look at a U.S. oil 30-minute chart, and during that U.S. overnight, you have a very, very low ATR. You can see where we are just sort of down here in really a trough type of an area. And then as we go into that U.S. Open, as we go into that 9 a.m. Eastern to 9:30 a.m. Eastern, you have an opportunity for participation to enter the market and potentially play a breakout above the top of our defined range. So we have a low ATR. We have a defined trading range. In this case, we're looking at about 80 something pips, 80 plus pips. You're looking to grab maybe the bid above the top of that range and get in on a directional move. Now, immediately on this U.S. Open, this one paid you off about 50 pips on this break. But if you wanted to take a position, your stop loss would be beneath the range, and you're still looking maybe to get in on that big move. Personally, as a breakout, I like immediate positive price action. In this case, that would be when your ATR picks up after a lull and you've got a key market driver right there. So those are three different ways you can trade the ATR. You could trade a reversal, as we saw with Bitcoin. You could trade rotation, as we saw with the US dollar CHF, and also that US oil breakout type of a trade. Really a versatile indicator and one that can put you into many, many trading opportunities. With the proper risk versus reward, it can be a profitable way to trade.
The biggest thing to remember about the ATR is this. It measures pricing volatility, not direction. If an ATR is high, then a market is on the move. If it's low, the market is in consolidation. It's as simple as that. Wilder's average true range is considered a classic tool for technical analysis. It can be used to trade reversals, ranges, and breakouts. Traders also frequently combine it with other indicators and analytics. If you're searching for a new approach to the markets, then the ATR is worth a look. Thanks for stopping by. Be sure to subscribe and follow us on the socials. Until next time, trade well, and we'll see you in the markets.